In this video, I am going to expose the 10 dumbest things that I see people do to save money on taxes that actually end up costing them more money in the long run. As a CPA, I see people frequently buy things they don't need, make very sketchy investments that they don't even understand, and make financial decisions that completely derail their wealth building strategy, all in the name of tax savings. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to expose these huge mistakes to help someone watching this avoid a financial disaster later down the line. So if that sounds good to you, go ahead and save this video, hit the like button below, and let's go ahead and jump in. Okay, mistake number one, letting the tax tail wag the dog. Now, this happens when people let tax savings solely dictate their business or financial decision, which is usually the first step to making a financial mistake. Because when you ignore the business or financial impact of an investment or a major purpose, yes, you might save some money on taxes, but that does not make that a good investment or a good purchase. For example, if you invest $100,000 into something that saves you $30,000 in taxes, someone focusing on the tax savings alone might say that that's a great investment. But if it is a terrible investment and you end up losing your money, then you actually lost $100,000 to save $30,000 in taxes. Or in other words, you would have lost more money from making this investment than from just simply paying your taxes. Now, a better approach would be to make tax decisions in alignment with your overall wealth strategy. Instead of reinventing the wheel to reduce your taxes, we just need to take a look at our unique circumstances and goals and find tax saving opportunities within that. For example, if you are a business owner, maybe you decide to invest more money back into your business as opposed to investing into something you don't know or understand. Or if you're a big real estate investor, maybe your tax strategy is as simple as buying more rental properties to continue offsetting your taxes, or using IRS criteria to qualify to generate larger deductions against your rental properties. There are different strokes for different folks, but the key idea here is to keep the main thing the main thing. Your primary wealth strategy is the main thing. Tax benefits are just the cherry on top. Mistake number two, spending $1 to save 15 cents. Now, this is a big math mistake that actually keeps people poor. Some people really believe that a tax deduction is equivalent to tax savings, when it is not. $1 deducted on your taxes is not $1 saved. Yet there are people who will buy things they don't need just to save money in taxes, thinking that their purchase is, quote, better than giving money to the government, without understanding that they are actually using bad math. For example, if you're in a 24% tax bracket and you get a $10,000 deduction, you're only saving $2,400 in taxes, not $10,000. So if you spent $10,000 that you didn't need to spend, you're still out of $7,600 net of your tax savings, meaning that this person would actually have more money if they simply kept it and paid their taxes. So if you're spending money everywhere without a clear purpose and then rationalizing the purchases you're making for the tax benefits alone, you might actually be costing yourself more money than you're actually saving in taxes, which is directly related to mistake number three, buying cars you don't need. So with the new tax rules, many business owners and investors are planning to use 100% bonus depreciation and Section 179 to buy cars and offset their taxes, which is great, by the way, if you actually need a business vehicle, and it will actually help you earn more income. Or maybe you are already planning to buy a vehicle and you're just using these tax benefits as the cherry on top, like we discussed earlier. But if not, you might be making a terrible financial decision. For example, some people will go out and buy a $100,000 SUV, somehow thinking that the tax benefits themselves will pay for the entire vehicle. Again, using bad math. For example, someone in the absolutely highest tax bracket of 37% who use the vehicle 100% of the time for their business might be able to save $37,000 in taxes on this purchase if the vehicle weighs more than 6,000 pounds. But even then, you're still out of $63,000. And again, that's the best case scenario. Most people watching this are not in the highest tax bracket and do not use their vehicle 100% of the time for their business, only limiting their tax benefits on this same transaction. Plus, if the vehicle you purchase weighs less than 6,000 pounds, your deduction may be limited to just $20,000 or so due to IRS limits on luxury vehicle deductions. So instead of making expensive purchases for the tax benefits alone, ask yourself if you actually need what you're buying or if it's just an impulse purchase. And two, if the purchase will actually help you make more money. If the answer to either one of these questions is yes, then it might make sense to maximize your tax benefits by exploiting provisions in the tax code related to that purchase. Now let's move on to mistake number 4, making risky investments for tax benefits. This is where people get into very big trouble. They hear about certain investments that may reduce their taxes, like oil and gas partnerships, real estate syndications, or other tax shelter investments that promise massive tax deductions or tax-free income. Now, these opportunities are usually accredited investments that require you to either have a certain amount of income or net worth to qualify. And those investments are usually marketed as having very high rates of return while generating passive income and huge tax benefits to you as the investor. And while most sponsors and advisors trying to get your money praise these benefits, they usually ignore one simple fact. These investments often come with huge risk. For starters, you are practically giving your money to a complete stranger with a company disguised as an investment opportunity, and you're trusting them to deliver on a promise and manage your investment, which I have personally seen go south many times. I have had clients with 7-figure incomes practically give all of their money away to save money in taxes, only to be disappointed with the outcome of their investments. And furthermore, as a passive investor in these funds, you usually have very little control over your investment, how it is managed, how you are paid, when you are paid, or when you will actually get your money back. Not to mention the fact that these investments are usually not liquid, or in other words, you do not get most of your money back until they have a major liquidation event later down the line. I have personally invested in these funds. I have had clients do it as well, and it rarely ends well in my personal experience. So I would just warn you to be very careful when making risky investments, especially if it is solely for the tax benefits. Mistake number 5, becoming a real estate investor when it does not suit you. I see this one happen all the time. People hear about real estate tax benefits and the ability to write off rental losses against their active income, so they rush out and go and buy rental properties. And to make this worse, some tax professionals will tell you that this is the only way you can actually reduce your taxes. But here's what they don't tell you. Being a landlord is a job. You're dealing with tenants, property maintenance, vacancy, and sometimes even evictions. If you don't have the temperament, time, or interest in actually managing your real estate, then please don't become a real estate investor solely for the tax benefits. There are plenty of real estate investors who go out and buy a bunch of properties, find out that they actually do not like it, and end up selling their properties because they simply do not want to deal with them anymore. The tax savings are not even worth it for them. Now, with that being said, on the flip side, for many people, buying real estate is a great wealth building strategy, and it does come with a number of powerful tax benefits like depreciation, which allows many people to greatly reduce their taxes. So I'm not arguing that buying real estate is a bad idea. I'm arguing that it is a bad idea for someone who is not cut out to deal with what it takes to be a successful real estate investor. Mistake number 6, buying complex life insurance policies for tax benefits. This is another big one. People get sold on whole life insurance, universal life, or other permanent life insurance policies because of the quote unquote tax-free growth and tax-free distributions. And it is true that many life insurance policies have a cash component, some of which you can borrow against to receive money tax-free. But here's what most people don't tell you. These policies often come with massive fees and commissions that can eat up years of your premium contributions. I have reviewed policies where clients were paying $50,000 annually in premiums, but only $20,000 was actually going towards their investment component or cash component after all of the fees and other insurance costs. Now, to be fair, there are legitimate uses of life insurance in tax planning, but the tax benefits alone are usually not the sole reason for buying that policy. There are many other strategies you can use to achieve similar results if tax savings is what you're looking for without paying so much money in fees and commissions. So make sure that if you're buying life insurance, you're buying it for the right reasons. Mistakes number 7, making investments you do not understand to save on taxes. This ties into several of the previous mistakes, but it's worth highlighting separately. I have seen people invest in everything from complex charitable giving schemes to complicated trust and other entity structures, all because someone promised them tax benefits. And honestly, some of these schemes are so complicated that most people do not understand them, which is usually a red flag to me. If you can't explain the strategy to a 12-year-old, you probably should not be putting your money into it, regardless of the tax advantages. As a CPA, I receive emails every day from sponsors soliciting these types of opportunities to me and my clients, claiming to have found some secret loophole in the tax code. And when investigating these opportunities, I have often found that they abuse tax rules, and some of them are even being audited by the IRS as you watch this video. These types of schemes are frequently audited by the IRS, and you have to be very careful when choosing companies to associate yourself with, as it may also increase your own audit risk. I once had a client who invested $200,000 into a tax advantage partnership that was supposed to generate losses for him on his tax return. And the investment opportunity was so complex that their attorney could not even fully explain it. And guess what happened? The IRS actually disallowed their deductions, making the entire strategy worthless from a tax perspective. Mistake number 8, not maintaining proper documentation for certain tax positions you take. Now, this might sound basic, but you will be amazed at how many people lose thousands of dollars in legitimate deductions simply because they cannot prove them. I have had clients with shoeboxes full of receipts they cannot organize, or even worse, no receipts at all for legitimate business expenses that they incurred, which puts them at risk because if you get audited and you don't have documentation to prove your deductions, the IRS can disallow them, period. It doesn't matter if the expenses were legitimate business expenses or not. So do yourself a favor and set up a bookkeeping system now, whether it's just a simple spreadsheet, accounting software, or even just organizing your documentation in folders. Mistake number 9, not doing tax planning before the year actually ends. And this is huge because most people don't think about their taxes until April when they're actually filing their tax return, but by then it's usually too late to do anything about their previous year's tax bill. Real tax planning happens throughout the year with a major push in the fourth quarter. December 31st is the deadline for most tax strategies. Once January comes around, there is very little you can do to reduce your taxes for the previous year. It's not like you can just open that year up and go and start making purchases and buying equipment to reduce your taxes that year. No, once that year ends, there's very little you can do. The difference between proactive tax planning and reactive tax preparation can be tens of thousands of dollars. So start tax planning now and don't wait until next tax season to start thinking about your taxes. And I'll bring everything home here with mistake number 10, not keeping the main thing the main thing. So look, if you find yourself paying a lot of money in taxes, it's because you made a lot of income, period. And the last thing you want to do is to spend less time on the main thing driving your income to spend time and energy on things that do not produce income. That just does not make sense. So yes, saving money in taxes is extremely important and can help you build even more wealth, but only if it is within a framework that actually makes sense given your exact situation. The best tax strategies are not pursued to just save money in taxes. Usually they are in full alignment with how you actually build wealth and help you do that. So my advice to anyone is to keep the main thing the main thing. Focus on building wealth through your business or investments and implement tax strategies that complement that, which is why it's so important to work with a good CPA that can recommend specific opportunities for you that makes sense given your exact situation, as opposed to just following generic tax advice, which may not be best for you. And if you need help with that, just apply to work with my team today at mycpacoach.com.